So let's start with the first question. I'm 45 years old now and only have 300,000 to invest. Is it too late and too little to start? What would be a good strategy to grow the investment for retirement? I think these questions, right? I think the best part about this is that it provides some important context for the friend that's asking this question, which is his age, 45 years old. I won't comment the 300,000 whether it is big or small amount, because sometimes if you really go through your entire financials, right, I believe it is not like you have nothing at all, just 300,000, just cash. I don't think it is as simple as that, because our financials, right, usually the bank, the cash portion, right, is just one of them. The other things that we would want to know is that, for example, like how much do you have in your CPF, how much, like whether you are renting a unit now to stay, or do you actually own your unit? Like, do you stay in HDB, condo, what kind of situations, what kind of arrangement? What's your family background? Do you have dependencies? So to answer, like to give a more holistic answer to these questions, right, the age part is very important, but aside the age, right, we still need a lot more informations in order to come up with things that is like helpful, right, to you. So the comments that I'm going to give, right, is more like the generic one without knowing your situations. So definitely this is not a financial advice. It's just me thinking like as a friend, like if a friend asking me these questions, what would I share with my friends, right? So the first thing I want to highlight is that 45 years old, right, it is like not here, not there. If I'm to tell you that you are still young, you are still working for at least like, let's say 10 plus years, you are not young anymore. Even I myself, right, I'm 39 this year. I don't consider myself as young anymore. But it is not also like, it's not 45 years old, it's not that old. Because when you think about like your future, right, whether pre-retirement or post-retirement, right, you need to prepare, like your financials need to be at least enough to sustain you for the upcoming 50 years, right? That's also quite long. So you are somewhere in between, right? So I think that makes the questions that you are asking, right, a bit more challenging. Because if someone to the extreme, right, let's say someone is like 20 or 25 years old, it's very easy. You can just say, oh, you DCA, S&P 500, even market crash, you don't have to worry, that kind of things. You can say that because still young, okay? And let's say if you are someone who is like that post-retirement, let's say you are 60, 65, then it's simple. It's like you don't usually at that kind of age, you don't have earning power anymore. You are in retirement anyway. You want to preserve your capital, and usually people will park their money with safe investment, right? So that is like, after 60 years old. 45 is in between. So I think that makes it more challenging to tell you that what you should do. And also it depends on your experience dealing with investment, right? I don't know what is this 300,000, but I think even if you have 300,000, even if you park that under, let's say like just bank deposits, right? To me, bank deposits is still investment. It's just that it is a very risk-free or low risk investment, but the yield is also very low. But of course, when we talk about investment, there's a whole bunch of different asset classes that you can go into, right? Say, for example, you can get into like bond funds, you can get into like ETF, you can invest in individual stocks, you can transfer more money into CPF. To me, all those things, right, they are all investment. It's just that each of these investment, they have their own risk-return profile, and you need to select those that really fit your needs here. So now come back to these questions here, right? Like you only have 300,000. What's my advice, right? Let's say if you are keeping this 300,000 mainly in cash and you don't have much into, let's say like stock investing, right? And judging from the amount of 300,000 and you are kind of like concerned whether you are generating enough yield or enough investment return to meet your retirement, right? And so you want to boost your investment return slightly, right? Of course, you need to get into slightly more so-called riskier investment. For example, like stock investing or let's say ETF investing. That one definitely can help you in terms of improving your investment return. It's just that you need to be mindful that if up until this point and you haven't really have a meaningful investment into, let's say like stock portfolio, right? Are you okay with that volatility or not? I think that's the first thing that you need to pay attention to. Don't just hear one story from a friend and then suddenly you just whack like 100,000, 150,000 into stock investment. You really need to take it slow one. Say for example, from now on, maybe you just put in, let's say like even as small as let's say $1,000 a month into, let's say, like a diversified ETF strategy, right? Just dollar cost averaging, just monitor the growth, monitor the volatility, and then see whether you can take it or not. Unless your expenses is really, really very low, like you can survive with, let's say, just spending $500, right? If not, right, 300,000 is an amount that I think maybe a bit hard to secure your entire retirement. Let's say you just stop working and just have 300,000 to meet your entire retirement, right? I think that's a bit stretch. That's why higher return is definitely helpful. But when you put your money at risk, right? Say, for example, you buy an ETF or you buy a stocks, and then let's say you just put 30,000 or 50,000 into it, and then it just lost, like, let's say 10 or 20 or 30%, right? When you take that, let's say, tens of thousands of hit into your portfolio, you will get nervous and you will get concerned because you only have that 300,000, right? It's not like it is super big amount where you can say, oh, if it is lost, then I'm fine. So I think naturally, if you put that money at risk and you are getting concerned with the volatility, right, that's perfectly normal. And that's the emotional part that you need to manage. So I think the best way is to take it slow, just put a small amount, just see whether you, in terms of your emotional, you can take it or not. And of course, let's say if you think like you emotionally you can handle, and then you also take the time to understand, to study, and to build the convictions. Even just S&P 500 also needs some convictions, because for those who don't know about S&P 500, it's still new. I don't know what is this. Invest in US stocks, whether it's risky or not, I don't know. So all those things, you need the knowledge to bridge the gap, to have the good understanding on what is the instrument that you are buying, what is the investment that you are investing in. At the same time, get comfortable with the volatility, take it slow, and then let's say if you have more questions, linger around with the community, asking people for opinions. Then that's how you start to take a step into investment that is somewhat riskier in the sense of it is more volatile, not so much about like the fundamentals. The fundamentals is totally different story, right? Then take it slow. I think that's the only message that I wanted to give. I don't want people to have no stock investment at all, suddenly just throw 100k 200k into stocks and then lost money and then panic and then sell again. I think that's the worst now. So the take it slow part, I think is very, very important, and gradual, and at the same time build up your conviction using like reading more, gain more knowledge, have more like-minded friends to share their journey, and then from there I think you can learn and can adapt into this kind of investment. But of course, let's say if you are saying that, okay, anyway, your other monies are all in let's say your housing, right? And as long as you don't have to pay rental, usually you can keep your expenses very low. And if it is so low that even 300,000 you can retire for a very long period of time, right? And you just want to keep your investment into safe investment, right? I think that's also fine. It's just that the risk of doing that is just that if inflation is much higher, right, and you don't have enough returns to support your retirement, right, that's also quite challenging. So there's a lot of considerations there. I hope all this commentary is helpful, but let's say if you want to give more context about your situations, and then of course we can discuss a lot more. But my commentary is more like looking at the age and the amount, and try to offer something that I hope is helpful. So that's my response on the first questions. Are we now recovering to all-time high now? Have invested 10% earlier, not sure if want to invest more or wait for it to come down again. The video that I posted 2 weeks ago, I say that don't expect that drawdown is like, oh, quickly few weeks drawdown and then within weeks and then we are back to all-time high and then market to continue to go up, right? I think we shouldn't have that kind of expectations. If you put your money into stock market, right, you need to be okay that the stock market will drop 50% and then stay there for, let's say, 5 to 10 years. That is the expectation, or at least readiness to take that kind of volatility. If you are not ready, or you don't have that kind of preparations, right, to withstand it, right, the emotional part, I think, is the hardest part to manage. So I always have the expectation that, oh, these things can drag longer. It can zigzagging, right? Let's say if you go back to all-time high, doesn't mean it is just smooth sailing from there, right? Maybe it create another all-time high and then back down another 30%, right? Who knows? Stock market is not just driven by the fundamentals one. It's also driven by sentiment, because sentiments is driven by news, and you can see that when people looking at stock market, most people are actually paying attention to news. They are paying attention to things that is hot currently, right? Say for example, the hot topics was tariff. Everyone is asking about what tariff, Trump. Like let's say 2 years back when it was Ukraine war, everyone is becoming war geopolitical expert and then just paying attention to that. So because of all this news highlight, right, people are paying attention to this, and stock market also is driven by this kind of sentiment, and it can be very volatile. To answer you in a short way is that definitely don't expect that to be a smooth selling. Market can be volatile, very hard to say. It can go back to all-time high, it can come back down, who knows, right? And whoever that tell you he knows, right, you just stop believing this kind of people. And also you shouldn't ask these kind of questions too often. You should direct your questions to ask like, what is my long-term strategy? Okay, I think that's a lot more important. Like for example, if I tell you market is going to recover and go up, or market can crash back down, given you don't know which one is the outcome, right? How would you do? How would you structure your investment? Some people can structure something that's very simple. Say for example, just say that I don't care about the market up or down. I'm just going to dollar cost averaging, do it on consistent basis, and just forget about the news. Stop watching news. Just do it on a disciplined manner, on a consistent manner, and just build the portfolio for the next 20 years, right? Some people really have that kind of discipline to just execute it. So to me, that's really good. We hope to have more this kind of people to just disregard the sentiment part and just build the portfolio and investing in let's say like a diversified portfolio, right? The reason is because when you have this kind of long-term strategy, right, what you are betting on is not the short-term timing. What you are betting on is actually a bunch of businesses that you think they are going to grow over time, and then they are going to become larger over time. Earnings is going to grow over time, and the value of your portfolio also grow over time. That's the only thing that you are betting at. You are betting on the general economy turn out to be much better. Although short-term can be volatile, short-term things can turn up worse. Let's say like a tariff hit, right? All the corporate profitability can be affected. If recession comes, right, our investment will be affected. Even the earnings number can dip temporarily, right? But over the long terms, they tend to recover and they tend to just go up, right? You just look at historical period. Recession comes, recession goes. All these, sentiments become bad and then sentiment recover. So all these are just common. Are just normal market functionings, right? So if you have a long-term strategy, you just execute, right? You will ask less questions about like, what is going to happen next week? What is going to happen next month, right? So that is really too short-term focus. So when I say invest for the long term, it's really like just convince yourself to stay away from all these short-term volatility, sentiment type of things, and just keep on remind yourself, focusing on things that don't change or will not change or tend not to change over the next 10 to 20 years, rather than focusing on the changing things. I think this one, Jeff Bezos also have a great quote, right? He said, people ask him, what is going to be different? What's new next 6 months or next 1 year? He said, very seldom people ask him, what is not going to change over the next 10 years? So I think that when it comes to investment, right, we also need to ask ourselves the same questions. What is not going to change? Because once you manage to look for things that is not changing, right, and you just bet on that kind of things, right? So for example, it could be as simple as, I think the technology advancement is not going to stop, and this is not going to change. We will keep seeing advancement every year over the next 10 years, right? Once you establish that as the thesis, right, then your investment can direct towards that direction and keep betting on that directions, right? It can turn out to be a very, very fantastic results. Think of what is not going to change instead of what is going to change. So that's my comment on this second questions here. I have 3,000 worth of investment capital. Is it worth diversifying? Feels like capital is too small to diversify. If not, what is the minimum capital to diversify? The amount of capital versus how diversified is your portfolio, right? To me, that is really two separate things. They are independent from each other. You shouldn't think of like, just because the amount is small, then you should concentrate or you should diversify or vice versa. So it is really totally different thing, okay? You need to look at them separately. But first thing, let me comment on the 3,000s first. 3,000s, you ask me, is it a big amount? Yes, I agree with you. It is a very small amount. Okay, not to say that my portfolio is big. That's why I say this 3,000 is small. I think for a new investor, usually they started with a small capital, right? So to me, 3,000 is just the starting point. You shouldn't structure your investment looking at what your current portfolio size. I mean, just take the 3,000 for example, right? When you close your eyes and think about what kind of strategy that you want to have, right? Don't think about the current 3,000 in the portfolio. You need to close eyes and think about 30,000. Okay, don't think about 3 million first. That one is a bit far, a bit hard to imagine. Let's start from something which is smaller. Instead of 3,000, you think 30,000. So if you have 30,000, how would you allocate? So whether it is diversified or concentrated, to me, it is a function of how much time can you spend doing your research. I think that's very important. Because say for example, right, let's say if you are our contra investor friend, right? He really like has the belief that he wanted only to invest in companies that he have knowledge on and he really know inside out. So, and he would really want a concentrated portfolio. So if you really do that, right, then of course, you shouldn't diversify. You should really concentrate your portfolio into like the companies that you research deeply into. It could be one stock, it could be 3, it could be 5, it could be even 15, doesn't matter. But if you really want to have a concentrated portfolio, right, then you know inside out of those companies, you really do your research. So you become like we call the individual investor or stock pickers. So that is really possible. But make sure that you invest in a concentrated manner, right? You really know those companies. Let's say if you just pick, let's say 5 companies, right? On average, it will be 20% per company. 20% per company, let's say just one company have a drawdown of, let's say like 50%, right? That's 10% loss of your portfolio. 10% is not small, okay? If you're okay with that, you understand the company inside out, 20% allocations, even let's say 3 companies, 33%, not an issue. But that's provided that you have time to monitor the companies, you have time to research the company, and you know the company inside out. So that's the concentrated investment approach, right? The other approach, right, which I believe is suitable to 80 to 90% of the populations, right, of the investor population, is that let's say you are like me, you are busy with your work, you are taking salary, or you have your entrepreneurship going on, right? You are busy, you don't have time to do all this deep research, right? You just want to have a diversified portfolio, right? Then just go for ETF, right? Because let's say if you have invested in S&P 500, right? Even the largest companies, I believe is still Apple, maybe, I don't know, still definitely less than 10%, right? In S&P 500. And the rest is like what, 5%, 3%, 2%, 1% kind of allocations, right? If you have that kind of diversified portfolio, you don't really need to follow specific company anymore. You just can, just do a diversified investment and then just close eyes and then just continue with your work, continue with your social activities, continue with your hobby, continue with your entrepreneurship. You just do that, right? So no issues. So diversified investment is also a good approach. It is really save a lot of time. Like you don't really need to monitor all these companies, because just to study the companies and monitor it, right, to me is quite a time consuming. It takes effort. But the fruits, right, is not just in the form of investment returns. Sometimes the fruit it could be just, that's one way for you to gain more knowledge about certain industry or about certain company or certain, aspect. Let's say if you are studying company, let's say recently I'm really looking into the Novo Nordisk, right? So at least it helped me understand the history of insulin and the history of all the GLP drug, right? So I think that one is really something that we can invest. At the same time, we learn something about the industry, right? I enjoy the process basically. So that one is also fine. So concentrated versus diversified, I think both are fine. And whether you are having 3,000, 30,000 or 3 millions, you can still do concentrated or you can still do diversified. So I think the aspect of like the size of the portfolio versus the how diversified is your portfolio, I think they are independent. But whether it is diversified or not, I think it is a function of how much time you can spend. What do you think of Alphabet futures, given Gemini daily active user isn't catching up with ChatGPT, but Google's search ad revenue remains stable? I think this is very interesting questions, and just reading your questions, right, I know you are really reading into very details because I think you can quote that the Gemini DAU isn't catching up. That is really one of the questions posted in the earnings call. So I think that's also quite a good questions. So now focus on the ChatGPT first. I think ChatGPT, right, they really have the first mover advantage here because they are the first one that came up with this AI chatbot chatbot, right? So I think definitely first mover advantage. And to be fair, I would say that if I compare across all the different chatbot, right, AI chatbot, right, I think ChatGPT is still the best one. Although I would say that Grok 3 is really catching up. I mean, in some area, Grok is already better than ChatGPT, but I would say generally speaking, right, I think ChatGPT is still one of the best, definitely. Of course, let's say if you talk about Google Gemini Pro, right, I think the most recent one, 2.5 Pro, I think that one is really, I just read about the reviews, it's really great. It's just that I didn't subscribe for that, so I haven't tried it before, but friends who are using that, right, they say it's really, really fantastic. So I think definitely when it comes to the product, right, you can see that it's not a winner takes all. ChatGPT is, of course, leading, but the rest are catching up very closely, right? So I don't think this area is a winner takes all, but still ChatGPT, because they have the first mover advantage, right? There's still advantage there. Now come back to Google business, right? I think when it comes to the Google search, right, they will still be around one. So let's say if we just look beyond, let's say like just 3 years, 4 years, 5 years, right? I think search won't go away. They will still be here, because ultimately search versus all the ChatGPT, all the AI things, right, they are quite different in nature. I believe some use case, right, people still prefer just to use search, right, and then some situation where you want to just give more context and then you just want to discuss in more details. I think in that sense AI is better. So I think this is really two different segments. So search will be around, and when it comes to Google, I think their infrastructure around advertising, right, is still very strong. This is not going away. So the stuff that I mentioned is like, for example, the bidding of the ad space, that kind of things, and YouTube will still be strong. And then when it comes to cloud, I think Google Cloud, right, will still, although they are not the leading one, but still that business is also not winners takes all. So they will be still one of the key players in AI. Cloud business. So you see all these businesses, right, whether it's AI, whether it's cloud, whether it's all these, they are one of the key players. When it comes to search advertising, I think they are the dominant player. So in terms of business overall, I think their business is quite resilient. I won't say that just because in terms of the Gemini, they are not as good or they are not as, leading as compared to ChatGPT, then the rest of the business have problem. I don't think that's the case. In terms of the resiliency of the business, I think they are fine, okay? I think they will be doing okay. The part that I think I mentioned in the past, which I think still one of my concern, is that really if you think about, like, let's say 5 years, 10 years ahead, right, the customer's behavior part, that's the part that we want to be more conscious of. Say for example, right now, as long as when you are thinking about, you are searching for something, right, let's say I suddenly just want to buy a luggage, for example, where do you search, right? Do you search in Google to look for a store, or do you search in e-commerce website, or how do you do this kind of search, right? So right now, most of the case, we are still using Google, because Google will lead us to the correct place, right? Then we will go, right? So they are the keepers, right? They direct the traffic. So which is still the case right now. But let's say 5 years later, 10 years later, we could be in a world similar to like Hers, right? The movie, right? Where you just have a personal assistant, and then you just, anything that you want, you just chat with the personal assistant, your personal assistant will arrange for you, right? If that's the case, right, what happened to all the Google advertising, right? Because Google advertising, ultimately, I think they are still like the attention real estate, right? Where everyone is looking at the screen, and if you look at the screen, there's all the ads popping up at the side, right? Those are really Google real estate, right? So if the entire search become different, right? Like in terms of the consumer behavior, when it comes to search, they totally don't look at screen anymore, right? So if that's the case, then I think we need to be careful. Like in that world, in that new world, will Google still be the dominant player? If it is not, right, that means one part of their business might be affected, and in the new world, if they are not the leading one, then of course their valuations, everything could be affected, right? Like in terms of their growth prospect also could be affected. But for now, even when it comes to AI stuff, I think Google, they knows that they can't afford to lose. That's why in terms of their investment, their capex, they really spend heavily, right? Both at meeting customer demand. At the same time, it's also make sure that when it comes to R&D, they really can't stop. They really have to be the dominant players. So that's why you see their Gemini Pro models is not like behind, right? So I think that they know how risky they are if they don't invest enough. So they have been investing heavily. And Google, they're always able to attract the best mind in the world, right? So I think on that sense, I take some comfort from there also. It's just that the world is always changing, technology is always changing. All these things, right? Like the personal assistant that I just mentioned, right? So far, there's like the one that we are seeing still not that dominant, right? Like for example, I don't use personal assistant in that way, right? But we don't know things can change over the next 3 years, 5 years, right? So just pay attention to those things. Yeah, I think Google's their business is still quite a big one. Like the advertising part is a lot of things to talk about, and I'm not the expert in this field, right? I can't go into that details, right? But I would say that when it comes to the infrastructure, when it comes to the dominant advertising space, right, Google, they are still doing great there. There are many things to talk about for Google because they are just big, right? Say, for example, another one that people want to discuss is Waymo, right? Waymo, when it comes to their autonomous driving, right, really pick up fast, right? They really roll out in multiple cities. The weekly paid rides, right, also is like scaling up very fast. Of course, Tesla is coming, so there will be competitions. You see, Waymo is just like one of their business, right? We still see there are many, like the AlphaFold things, right, in biotech, right? It's still a lot of other things. So Google, I would say, is a conglomerate of so many things. To summarize is that when it comes to their core business, they are still very strong. When it comes to the new stuff, they are one of the major player. They are still competing, but some of them, like the ChatGPT one, they are really not leading, right? But they are trying hard. Long question, long answer to these questions. But sometimes I look at your question, I know that you are reading those details, right? So let me just go into those like more details instead of like just talking surface. I hope that's useful to you. I'm a retiree and wanting your thoughts on the following. I'm invested into Berkshire, Mercer, VOO, SMH, SPGP in equal amounts. It is a conservative, diversified, but also with growth potential. I bought 200,000 in each. Ooh, okay. Like I mentioned in the first questions, right? If you are a retiree, right? I think when it comes to the goal, right? You really need to tune out the capital preservations versus the seeking capital growth. Because I believe, let's say by retiree means that you really no income, maybe other than, let's say, some rental incomes, stuff like that, right? Or dividend incomes, right? So you don't have your active income anymore. So I really think that the capital preservations need to take priority. And with that said, right, when it comes to investment, the first thing that I ask is not about the diversifications within your equity portfolio. Because to me, right, even if you have really diversified within the equity, right, let's say you already have the VOO, right, 100% VOO. So VOO is like VOO is S&P 500, is quite diversified, but they are all stocks. So all these stocks, right, just what we experienced in the early April, right, they all can come down at once, so at the same time. So with that said, as long as they are in stock portfolio, whether it is diversified across 5 names or 20 names, right, I think they are still quite risky for a retiree. So the real diversification is that you need to have a bulk into, let's say like stock portfolio, right? Then you need to have the other pile into, let's say, some bond portfolio, some real estate, some, let's say, a little bit small amount in commodities. To me, this different asset class diversifications is a lot more meaningful as compared to the diversifications within your stock portfolio. Given that you are a retiree, right, some money in, let's say, like bonds, in high saving rate account, right, like all the money market funds, I think those are a lot more helpful because you can treat it as cash and you can spend, right? Whereas, let's say, if your money, bulk of your money in stocks, you need to sell stocks to fund your retirement, and you need to sell anyway, right, as you need the money. So that volatility is something that you want to, pay attention to. Diversifications, the asset class one is more important. Okay, I want to stress that. Now, to answer your questions, right, come back to like different names under the stock portfolio, and you mentioned that it's really 200,000 each, right? To me, 200,000 each, and how many names you have? Let's say 1, 2, 3, 4, 5. That means it's like 1 million divided by 5, right? If 1 million divided by 5 is 200,000 each, right? Aside from the ETF, right? Like Berkshire, I think they are quite. I mean, it's a low risk investment, right? Given that the amount of assets that Warren Buffett kept, right? Mercer, I think that one is also fine. In terms of the names, I think they are fine. It's just that in terms of 200k inside one name, and when it becomes volatile, let's say even Berkshire Hathaway stocks, right? It can be volatile one. As long as you are fine with the volatility, then I think that's fine. So that's the only thing that I want to share is that once you have too much money into the stock portfolios, sometimes you need to be okay with the volatility. Thanks for your advice. Very good. I do not need to draw down to my fund living expenses for the next 10 years. Yeah, definitely. If you are fine with the, like, you don't have to draw down and you know Berkshire. Those people who invest in Berkshire, they really know Berkshire, right? And if you have that kind of good understanding, even if the share price is volatile, you are fine, you are cool. I think even 100% into Berkshire is not a problem. So, sometimes when I answer these kind of questions, right, because I don't know you, if I know that you have been attending Berkshire Hathaway meeting over the last 10 years, right, and you really know the philosophy. I mean, this type of investors, when they don't even look at stock market volatility one, so it's really seasoned investor, right? So then you are the one that need to give financial advice to me already, not the other way around. So that's why I think it's not an issues with that kind of portfolio allocations. It's more like, if you tell me you don't have to draw down the amount for the next 10 years, right? I believe you have sufficient money, whether it's like in CPF or in some other annuities product or in some kind of other savings, right? So you already have your diversification, right? It's just that when it comes to your portfolio, that's how you allocate it. So to me, you're fine with that. So no problem. Should I make call options for NVIDIA before their earnings release? I see potential, but I have not done options trading before. Okay, so we are jumping into things that's outside of long-term investment, okay? So the first thing is that you are talking about options trading. So options, right? I think of it this way. Option is just instrument, okay? It's just financial instrument. It helps you do things that, let's say if you just buy, sell stocks, right, you can't do. Say, for example, there are people who using options to sell insurance, right? Basically, they sell out money, put options or call options. You can basically sell insurance, but you cannot do that if you are limited to stock investment. So definitely it's interesting instrument. And then there are people come up with all sorts of different strategy when it comes to options. If you are interested with that kind of things, I think I won't stop you. It's same for those who are very interested to, like, let's say trading. You want to trade, you want to get in, do day trading, in, out. I mean, you do you, right? So there's no way a random persons on the internet can tell you what you should do, right? So you should do your things. But when you say you are new, right, that's where I want to give a bit of, like, cautious kind of, I need to caution you. Because option itself is already quite complicated in terms of the how the payoff works, how the margin works, like how do you pair the options, the strategy versus your stocks, how do they come together, right? You need to learn all the payoff diagram things. So it is quite complicated already, but doesn't mean you can't learn, right? Anyone can learn. To me, it's not rocket science. If you read enough, even if you watch those, let's say like 3 hours options video, you can learn. There's nothing that you cannot learn, okay? So you can learn those kind of things, no problem. You can try, no problem. It's just that that's not something that I advocate now, because, my channels, right, or the Telegram group is really encouraging people to invest in stocks, treating it as a business, and then you invest, you hold for long term. That's what I'm advocating for. When we talk about options, these kind of things is really not in the school of thoughts of long-term investment. So that's why it's a bit hard for me to, I don't want to criticize. I think it's fine to do it as long as you have the interest. You just want to learn, no problem on that now. So, but it's just not something that I want to advocate now. So that's the options part. The other part is the NVIDIA part, because NVIDIA, we all know that, for those who are like not new in the group, right? Because I invested in NVIDIA, even during the Backholder Pod, I talk about NVIDIA quite often. People know that I'm the investors, okay? And it's indeed my top positions now. I have good returns from these stocks. Really, it up more than 10x since my first investment. We can talk about NVIDIA as a long-term investment, right? That is very separate story as compared to how would the results looks like, the upcoming earnings release, right? So that's the part where still we talk about the same company, but we are not talking about long-term things. We are talking about the short-term things, like you want to bet on whether the news is good or bad, right? So I want to encourage you to focus on the long-term things, because those are the things that it will serve you over a long period of time. Like, let's say if you understand the business model, right, and then after 1 quarter, after 2 quarters, after 1 year, 2 years, their business model sometimes they can drift, but they don't change that fast one. But if we discuss about like what's upcoming quarterly result, right? So these are the things that you, even if you have good insights, right? After 3 months, right? That good insights is like, useless already. It expire within 3 months, right? So even if you have good insights, you need to keep on refreshing, need to like look for the things that people don't know about, and then need to look for the new insights that can work for that 1 month or so, right? So that is part that I try encouraging people not to do on that. So don't bet on this kind of things, because I give you one example. Tesla, right? They just released their earnings, right? If you look at their earnings numbers, right, it looks really, really bad. Okay, I'm a Tesla investor. I still have like long-term conviction of the company. But when I look at the earnings, right, when it is bad, right, just admit it is bad. But bad results come up, suddenly the stocks just went up how many percent? More than 10%, right? Since the earnings result, right? So even if you are able to bet that the result will be good or bad, doesn't mean that the stock price will follow, because sometimes they can, just get out of sync entirely, right? I mean, the most recent one definitely is Tesla. Just look at that. So to me, right, even if you want to bet on short term, right, you need to be okay that these things, right, is super not reliable one. By not reliable means that, let's say if you just do a short-term bet and then you turn out like lose money, then you just need to suck thumb and move on. So I don't like do these kind of things that, it is like a one-off. It's similar to me going to casino and then bet already lose, go home. I don't like that kind of feelings. To me, I prefer to put my money into a stock portfolio. I understand the business. I hold the business for many, many years. And then I, enjoy watching the paint dry, right? Watching the company grow, right? I watch NVIDIA grow their revenues by I don't know how many X already. But that's also because the revenue shoot up very fast. But even for other companies, sometimes even it is a slow growth, right? Let's say just a 10% growth, right? You hold it for 4 or 5 years, suddenly it just like, the revenue already grown by 50% since you first invested in. So that's the part that I want to encourage more people to have this kind of like philosophy when it comes to investment, rather than just every time thinking of, I want to bet on this, bet on that, bet on short-term thing. Options, I mean, it is fun. I don't know. I don't know. The option part is really not something that I want to discuss more in my channel. Go watch other channel. There are other much better channel on options. If you enjoy those kind of things, go and do that. Just not something that I advocate. All right, next one. Is your Bitcoin holdings or chickens Alibaba going to reach the moon first? Both have been building momentum lately. Wow, my Bitcoin holdings, right? First things is very small. Second things is inside my cold wallet. I haven't looking at that for many years already. Sometimes even if you ask me like my Bitcoin holdings, how big it is, right? At today's market value, right? I have a hard time to just come up with the number. I actually don't know. I need to go and track my holdings and then multiply by the price to know how big it is. To me, it's really bought and then forget about it and then just let it park there somewhere. I just want to hedge against the scenario where, suddenly, let's say one day Bitcoin is already $1 million. I have zero exposure. I'm not okay with that. So I buy like very small portions and then I just store it somewhere that I cannot see it. Then I forget about it. That's my strategy. Alibaba, I think they have been doing quite well lately, but of course, every stocks get affected by Trump tariff. But the good thing about Alibaba is that I think, let's say if China side, right, they really want to pump the local stimulus, right? I think Alibaba will be doing well, right? They will benefit from, let's say, like the local consumerism. I think they will benefit. But again, Alibaba, I don't know. I have not much comment on the business because if you want to comment on the business, you want to understand, let's say like the China e-commerce, and by understanding China e-commerce, you need to know the macro situations in China now, right? So yeah, no comment on this. Please watch Chiking's video on Alibaba related contents, okay? If you ask me which one going to moon first, I need to define what is moon. If my investment in Bitcoin is like this kind of small, and Chikeng's Alibaba is like much bigger, right? Let's say Alibaba just 3x or 5x, he already at moon, but Bitcoins maybe need to be at $2 million per coin, then only I'm at the moon. So definitely Chikeng will reach there before my Bitcoin reach there. Kelvin Tesla all in, stock went sideways, sold monthly options, entire stack without monitoring. Now 50% fair value, what was FV? Fair value or future value of free cash flow stocks. A bit with the short term. Now 50% FV free cash flow stocks. 50% ETF, drastic change, Kelvinlearnsinvesting. Wow, this one, maybe post these questions to his YouTube and then see whether it will entice him to make a video to respond to these questions. I have not much questions. I think you and me, we heard the same thing from him. I can't give more context, right, other than what he has said, right? So I don't want to comment on this. It's a bit like, I need to defend him or what. So let me give it a pass. Okay. Do you believe NVIDIA will only have stellar returns only in an optimistic bull case where they exceed expectations? Base case, bear case, it won't be that great. I think NVIDIA case, right, is a bit interesting. Generally speaking, right, definitely you need the result to be better than expectation in order for the share price to go up. So that one is given, not just NVIDIA. It's true for any companies. Let's say a company where people thought that the earnings will drop by 50%, suddenly earnings drop by 20%, the share price also go up. So that's the actual versus the expectation things, because share price always react to unexpected results, right? The expected one, say for example, let's say if you expect it to deliver 30% growth, then it deliver 30% growth, I think share price will be just, be at around that level, right? So that one definitely true. Okay, now come back to NVIDIA. So basically you need to answer two questions here, right? The first one is that actually when we say expectations, what's the expectation? Okay, this is also something that is quite vague already. There's no clear expectation one. Say for example, let's say in Tesla case, right? Why the share price shot up so much after they just deliver such a bad earning results, right? I mean, with hindsight, you can say that, actually, most investors are expecting the results is even worse. Then now come back, the result isn't as worse. That's why share shoot up, right? So, I mean, you can argue that with hindsight. Whether it's true or not, I don't want to comment, right? Now, come back to NVIDIA, right? What's the expectations? The expectation is not clear one. One thing that we can look at is the analyst estimate, right? So you can track, let's say, some analysts, they expect, they come up with inside their report one. So you look at their report, right? Usually there will be financial year 2022, 2023, and then 2024. These are the actual one. And then maybe two more columns which they put on their expectations on the revenue, earnings in the next 1 year or 2 years. So you have those analyst report come up with this kind of information. There are people who aggregate this kind of information and then they call it consensus estimate, right? Whether it is going to grow at how many percent. You can refer that. I mean, just refer, not to say that is the ultimate expectations. Then, of course, the ultimate expectation is those that is priced into the share price. And that's why it's a bit hard to say. So if you look at those analyst expectations, right, NVIDIA, right, I think when it comes to growth, right, I don't think analysts are expecting them to grow, let's say, for 30 or 40% for the next 5 years. I think it's actually lower than that, because I think most analysts still believe that they are going to have a high growth for until end of this year. And then from next year, because we still don't know what kind of capex that, let's say, Amazon, Azure, Microsoft Azure, or Meta, or let's say Elon's XAI, right? How much they are going to spend for next year capex, it is still unknown. And that capex spends will determine what is the overall growth from NVIDIA for next year, right? So for this year, I think it's kind of like security. Everyone agree that whether we will have recession or not, NVIDIA is going to grow, at least until end of the year, right? Next year, people don't know. And when people don't know, right, the expectation is actually somewhat lower, like not a crazy number. But even if that number is, let's say, just 20%, actually, we don't know whether they can grow 20% or not. It could be, like 15%. If that's the case, right, maybe share price will drop. I don't know. So, I mean, these kind of things, when you are talking about like, whether they need to exceed expectation or not, and the first thing is to know what is the expectation, right? Second thing, you still need to answer the questions like, will they exceed the expectations? So to me, it's just like too much unknown when it comes to this kind of reasoning. And of course, when you are betting or speculating on things that is like just, let's say, 2 quarters, 6 quarters from now, right? I will tell you, it is very, very hard. You can come up with your view, you can guess, you can bet on it, but to me, it's just a bet. Like, yes, you can turn out to be right, or sometimes you can turn out to be wrong. We all hope that you turn out to be right most of the time, and then you have much better results, right? But to me, this part, right, is not easy one. It's not for everyday person, right? To have that kind of really good insights to make an informed decisions on to bet on this kind of horizon. But when I invest in NVIDIA, right, I don't invest in the upcoming 2 quarters, right? I don't invest in that, right? If I invest on that, right, I won't be able to buy NVIDIA, let's say like, a few years back. To me, it's really like understand the management, to understand the business model, to understand where they are strong at, and then trust on the management, trust on their executions, and just ride on the next 10 years rather than riding on the next 2 quarters, So the next 10 years, I have good enough thesis to say that they are going to have a space in AI, they're strong in all these things, right? So that's why I'm betting on the next 10 years rather than the coming 1 quarter, 2 quarters kind of things. Yeah, so that's my comment on this. From Anonymous, why never run for elections? Elections. Can I run for elections? I don't know whether I qualify or not. No lah, I'm not a politician. Managing online community is hard enough already. I can't imagine managing, like the local. Not so easy lah. But let's say running's definitely is no for me. I don't think I'm qualified. But let's say be more active, and then let's say contribute a bit. Let's say even as simple as like, let's say giving feedback. I think volunteering. I mean, those are the things that I still can imagine me doing maybe in the future. But let's see. Novo Nordisk or ASML. I think this is quite interesting because these 2 companies, right? These are the promising companies that are not US based. Because I look around, right? Let's say when we talk about technology companies, right? Most of them are actually based in US. Okay, like all the Magnificent Seven, right? They are all US based, right? So when you look at, let's say, Europe, actually not many technology companies that are super good, but I mean they are. I'm not saying that there are none, right? So these 2 companies, I think they are quite promising. So for those who don't know, ASML is really the companies that do the lithography machines, right? They sell the EUV, DUV to the chip manufacturing companies like TSMC and Samsung, and then they use all these devices to basically fabricate the chips. So SML, when it comes to the EUV, EUV is the extreme ultraviolet, like the very, very tight 13.5 millimeter wavelength, right? They are the only one company that's able to manufacture this kind of machines, and so it is a monopoly for EUV. Even for DUV, which is something that is more legacy, older products, right? Still, I believe they command quite a sizable market shares. So when it comes to semicon right, fabrications, right, there are multiple layers, okay, multiple different steps, right? When it comes to the lithography, by the way, lithography means what? I think the litho parts means light. So they're using light to process on the chip, on the silicon, right? So on the lithography steps, right, I think ASML, they are the monopoly. But there are other steps that is like oligopoly, and there's market shares with other companies, right? It's just that when it comes to lithography, it's just one player. Basically, it's SML. Right? Novo Nordisk, this is the company that I heard about the name for some time, but really haven't spent time to study about it. It's just that recent days and weeks, I start to understand more about the companies. Interestingly, I thought that this company is a pharmaceutical companies that have like a conglomerate kind of business, like many different drugs, right? Apparently not so. They are really just big into insulin, and then now with the GLP drugs, right? I think these 2 added up together is like bulk of their business already. In other words, let's say if you snap a finger and then all the diabetes or diabetic patients in the world is cured, right, then their business is gone already. Their business is really concentrated into just the diabetic or pre-diabetic situations. Say, for example, like the obesity, right, which GLP is trying to solve, right? This is also quite an interesting company. They are in pharmaceutical space, and they have their R&D. They are able to invent a drug like GLP. I think that is really crazy. For those who don't know about the GLP, right, basically that is like you snap on you and then you won't get hungry, and people who use it, right, can turn like from 100 kg suddenly just slim down by 50%. It's really, really crazy. So they say that they don't even need to advertise. If you spot someone just suddenly shrink in size, right, maybe you can ask the person that whether you use Novo Nordisk or this kind of GLP drugs. So they are not the monopoly, by the way. I think Eli Lilly, right, they also have their GLP drugs, right? So it's not a monopoly, but still I consider that as oligopoly, meaning that there are not many companies that are able to come up with this kind of drugs. So after these GLP drugs started to sell, right, their revenue is really going up like crazy. So I think that's quite interesting about this company. I'm still early in my research. I'm still reading about like their history. But let me just also take this opportunity to just give you a snapshot on how I do this kind of research. So like I said before, right, I don't really bet on short-term things. I don't bet on their upcoming earnings. I don't know how good they are. I really spend, days, weeks, months to study the company, including their history, including their main business core models. And hopefully I also have some insights into like the R&D phase of all these drugs. To me, that's an interesting topic to learn more into. But before I get into those, right, I need to be convinced myself that their financial is good, right? So usually when it comes to research, right, let me just share a bit more on this. Okay, so I think for these companies, right, I really like spent 3 hours plus to listen to this Acquire podcast, right? They really went through the details about their history, their foundings. I think that's very interesting. For those who are interested, just listen to the podcast. And then I think this one from App Economy, right, is really a good snapshot, even for those who can't read financial statements, right? To you, let's say it's too boring, too many numbers, you can't really read that, right? But I think most people still visual based, right? You can look at this. This is a good visual, right? The first thing to look at is that the green bar, right, on the right hand side, right? How many percent of the revenue actually flow to net profit? This is really quite a high net margin business. So very, very, very thick green bar there on the right hand side. And then on the left hand side, you can also see that what's their business, right? You see the GLP, the glucagon-like peptide 1, right? Or GLP-1 business, Ozempic and Victoza. This one is already like the bulk of their business already. And then diabetic drug like the insulin, right, is also a big one. Other diabetics one is 0.5. And then obesity care, actually the Wegovy, right, and the Ozempic, they're essentially the same thing. It's just that they target different segment. One is really to those who are diabetic patients. The other one is really just targeted those who just think that they want to slim down. So it's a obesity care business. So it's different segment, but still it's the same drug, right? So that's the Wegovy part. So they have others like rare disease, others I don't think that's big. So their business really transformed after they have the GLP-1, right? So that is really the transformations that they went through. I think this Ozempic and Wegovy business, right, is going to grow a lot larger. So just because people are paying more attention to obesity, and obesity leads to other disease, right? So this is something that is really people are paying attention to. So yeah, I think this is some business that I am interested to study. Just some highlights, right? Like I say, if you are not good at looking at numbers, sometimes looking at charts like this, looking at their revenue growth since early 2023 really go up a lot, right? And then you look at their gross profit margin, right? It's like, when you look at this volatility in their gross margin, actually it's none, It's just range between 82.5% to 85%. It's really very tight. Their gross margin is quite very, very high and very, very stable. So this is a sign of monopoly or oligopoly. Then when it comes to the EBIT margin, this one is a bit more like the operating margin. Like it's really, even in 2021, it was like 40+%. Now it's like 48%, right? So it's growing like crazy. So fundamentally, this is a perfect company to invest in. So looking at their operating income is also going up like crazy, and then diluted net income also going up. The reason why I suddenly interested with this company is that I noticed that the share price has been like dropping like crazy, and then sometimes let's say if it dropped like crazy, it just moved from 300 PE to let's say 80 PE, right? Still expensive, but not the case for Novo Nordisk. So you look at the forward PE, right? Currently it's at 15 times, and it is traded at such a low forward PE relative to their historical level. So that's why I was like looking at this. Wow, so maybe it's time to do some research and might be a good chance to invest in. But remember, I'm into this research only for a few days. So I really don't know much. Let's say if you have more to share with me, feel free to leave your comment at the comment sections. Then when it comes to the earning per shares growth, I think it's not like super high. They are projecting about 16% for the next 5 years, but still, at least it is not projected to drop in growth, right? To have a negative growth, right? To me, that's good enough already. So I think at one glance, all this financial all looks good, right? So that's why I would say that at least it enticed me to spend more time into the research and then just to decide whether I want to have some allocations into these companies. What do you think of NVIDIA with the restriction of sale of chips to China market and suppressions of margin as chips become more commoditized? Actually, okay, to China one, definitely there will be some hit and we will see the results in the upcoming quarter. So there will be some write-off, no problem on that. In terms of the share of, in terms of their share of business that go into China, right? I think it's relatively small as compared to those that they sold to US businesses. So overall, I think they are still the supply constraint. I'm not worried, at least for the next 2 quarters. I think they are going to grow, no problem on that. It's just the write-off part, right? Because the chips or the servers that they ship to China is really meant for China market, right? I'm not sure whether those chips, how much of them can be repurposed or can be sold to other markets. So that's the part that is a bit more challenging. But let's say if they just divert their supply, right, to US markets, right, I think they can do that now. The suppression of margin part, that part, right, I don't know where you heard that. For now, the margin is still very decent. They still command pricing power for all the latest chip that they're coming up with, right? So for now, there's no suppression of margin at the moment, okay? Whether it will come next year or not, hard to say, okay? But suppression of margin, just look at the margin number and see whether it is really coming down. So I think long-term wise, I'm fine. It's just the next year growth part, I don't know. Let's say if suddenly the growth just dropped by 10% next year, right? I mean, the share price can down a lot, right? So that's the part that I don't know. A bit hard to predict. Yeah. But long-term wise, I don't think this company is going to suffer. I think they will be fine. You think of it like NVIDIA, right? Their business, right? Although they are mostly B2B, meaning let's say the data center business, right? They are selling to sovereigns, they're selling to corporates. The gaming business, of course, they're selling to consumers, right? Now the data center business is just so much bigger compared to the consumer market, right? So I see them as B2B. But when it comes to the business, right, how they structure their product, their software and hardware, right, they are actually very similar to Apple, meaning that you need the hardware, you need their hardware to run their software. And when you need their software, you need the hardware, right? So, and the hardware and software is so tightly integrated that you cannot say, I take their hardware and port to another software. It doesn't work like that. So it's quite similar to Apple iPhone. Like people use iPhone because their stuff is like they're into that ecosystem. So you can't get out. And once you're into that ecosystem, right, you use the software that is available. By software, I mean including their platforms, their app ecosystem, everything's together. So the hardware software is more like, form an ecosystem, right, that trap you in. And you are in there, you're hard to get out already. It's very similar when it comes to NVIDIA business, whereby you need the hardware to run their CUDA, and on the CUDA platforms, you have all sorts of different, let's say, libraries, CUDA library, all those things, right? And that one really helped us a lot for the AI researchers. And now you are inside the ecosystem. Of course, you can build something outside. It's just that it's a lot harder and a lot more take on too much effort. So that if you want to be fast, you just pay and then you get it fast, right? So that's how they trap the users into their ecosystem. That's about the NVIDIA. That's the part that I'm betting on. The part about the growth, that's the part that I really have no idea. On Tesla, how do you explain the strong price rise post its recent result, which was very poor, especially auto sales across all geographies? I think this part, right, partly also because they explain, right, the Q1 sales is very bad, partly because of their best model, which is Model Y. They refresh Model Y to the new Model Y in all gigafactories in 1 quarter. Everything done in 1 quarter. So every hit into the same quarters, right? So you look at Q1 numbers, of course, they are bad. But actually, now Q1 number is already out. Now people start to speculate about the Q2 numbers, right? You don't know what is the Q2 number. Let's say it is weak in Q1, right? You don't know whether it will stay weak or not, because you don't know how much is the drop in Q1 is really because of all these Model Y revamp kind of things. It could rebound back to just their normal level, right? Or it could stay low. I don't know. I think it is that uncertainty that now most short sellers, not to say most, some short sellers is like, okay, I am betting on the bad results. Now the bad result come out already. I don't want to continue with the bet. I just need to close my positions. So I think that could be one reason. And then second reason is that, like, we don't know. It could turn out to be a much better growth sequentially, right, for Q2, right? Just because suddenly Model Y, now they start to ship already, and people who have been waiting for the new Model Y, they wait, just wait for the new models now come out already. They just bought it in Q1 or Q2, right? And just wait for the vehicle to ship, right? So maybe their growth for the next 2 quarters might be a lot better. Who knows, right? So it just moved from, we know the result is going to become like, actually we don't know how good it will be or how bad it will be. So just that movement alone is already some improvement, right? So that could be one reason, right? So I actually don't know all this in details. To me, it's just like, I think Elon mentioned in the earnings call that he thinks that Q1 numbers has been bad because of the Model Y things. And then secondly, he thinks that might be bad because of the macro situations, but when it comes to people wanting to own Tesla, right, he said that the demand remains strong. So that's why they've been working hard to try to lower down the cost so that they can serve the mass market, right? So that has always been their strategy. Next one. Tesla pump is because of Elon Musk's comment that he will start to move away from Doge and focus on Tesla. I think that is also very key one, okay? Because like he said, he's not going to spend bulk of his time in Doge because most of the work is already done. But still, he will spend some time to let's say if he have some hiccup, he will still spend some time. He's back to Tesla basically. That's what he mentioned. I think this is also one of the reasons. Thanks TKY for mentioning this. Yeah, I missed this earlier. How to join your Telegram group? So I'll put the Telegram group link at this comment later when I post it in my video. Anyway, if you look at my YouTube video, right, any one of them, there's the link. But I will text you and just want to make sure that you are legit persons. Sometimes you look at other public groups, right? Those who have like 3,000, 5,000, 10,000 members, right? I tell you, the admins, right, is working hard to just delete all the scam message that come in. Mine, I would rather make it a bit more tight when admitting people in, so that I don't have to be so tired. Need to keep on policing the chat group. So I will text you, or you can text me on Telegram, and then just let me know. I will admit you into the group. From Jeremy Tan. Hey Bunty, thanks for the kind words you sent to Mark. I do watch your channel sometimes. Going to do walkabout now. Have a good one. Wow, from Jeremy Tan. Jeremy Tan from Mountbatten. I'm a bit surprised. Am I getting the right persons? You say you are going to do a walk now. I was surprised. Wow. Okay. So just now someone asked, like, okay, you're going to run for elections. Here you go, Jeremy Tan. He's really running for elections. Mountbatten. Support. Wow. Okay. Next one from one thing from TKY. One thing bad about pharmaceutical companies is that the patent, semaglutide Ozempic Wegovy patent right is set to expire in 2032. Yeah, I think that's true. Like there's always all the uncertainty about the R&D. Okay, so there are two parts, right? First thing is that they do R&D, and then the failure rate is quite high, okay? And it is very costly. And once you get the patent, right? Once the drug successfully launched, right, you get a patent. It's not forever. It is just for a fixed period of time so that you can recoup, you can get good enough earnings, right? And then of course, those part of those earnings you need to throw back into R&D and then invent new drugs again, right? So once the patents expire, the pricing power will be gone, and then it's very hard to get very good returns already. So definitely, this is things to do with pharmaceutical companies, and you just need to be okay with that, nah. So that's the pharmaceutical part, and I think the other part is that when it comes to R&D, right, sometimes, like the drugs that you are currently selling, right? Let's say you are selling insulin, GLP-1 now. Let's say 10 years down the road, your competitor just invented a magic drug, and then it can, if that magic drug really take over, right? Like they really substitute your business, right? That means your business is gone. So there's always all this uncertainty that your business will be gone just because a new drug being invented. So you need to be okay with that if you invest in pharmaceuticals. And let's say if we are talking about Novo Nordisk, right? If their business is really so concentrated into all the obesity related disease, right? It is quite risky investment. So to me, okay to invest doesn't mean okay to put, let's say, 50% of your money into at least one company. You need to be okay with the risk. So you need to read the 10K filings and then just read all the details, like what are the risks. Need to be okay with that. Yeah. Well, thanks a lot, TKY, for your comments. Very, very insightful. On April 30, the US will release economic report on the GDP and consumer spending data. I'm holding SPDR right now. Should I sell it off before the release? The answer is no. If you are investing for the long term, you should just hold. Stop watching all this economic data. And by the way, let's say the GDP data, right? Out of so many economic data, right? The GDP data is the one that is lagging, meaning that no use one. If you watch GDP, right, everyone know about the GDP will be down like few months before the numbers come out. So it's always the lagging one. Yeah, of course, there are some economic data that is, not the leading indicators. That one, those that you need to watch. For example, let's say like the PMI is one of the leading indicators, right? But when it comes to GDP, it's really, really useless one. Please stop looking at all this data. If you hold Spider, SPDR, I believe you mean the SPY, right? If you invest in SPY, meaning that you invest in diversified investment, just hold on. Do a dollar cost averaging. Don't watch all this economic data. Next one, does it make sense to hold on to the DCA and wait for the opportunities like recent 20% dip to buy? Okay, DCA, right? What it means is that you consistently deploy your money just regardless what happened, okay? Just consistent. For example, every month, $2,000 or $3,000 or $5,000 go to the ETF. Just do that. Market jump, you buy. Market down, you buy. Market low side, you buy. That is the so-called the DCA. You always buy the same amount, okay? If you do DCA, that means you try to get rid of the market timing, okay? You don't want to get in and out. You don't want to have a cash saving aside and then just only investment when market drop. So that's DCA, right? So and then the opportunistic buying, right? Like let's say wait for market drop, then only you buy. That is really not DCA. Doesn't mean you cannot do that. Some people they do both. For example, you have $2,000 every month DCA, regardless. You just do that for the next 20 years. That one will go. It doesn't matter if it's raining or snowing. You just do it consistently. At the same time, you can still have some cash at the sideline. And let's say market just drop, and you just want to be more opportunistic. You just buy, right? So you can do both. It's just that you need to be very clear that when we say DCA, right? Once you have the DCA in place, you don't disturb that. Let them continue. So that's how I see it. Okay, next one. If USD dominance is at risk, slowly devalue, what should we do with our portfolio to gain from these situations? This is a bit hard. By hard, why I say so, right? It's because actually it is more like a hypothetical questions, right? Like if USD devalue. Of course, if you invest in anything that is US related, right? US devaluation is always a risk for you if you are not in USA. Okay, that is definitely a risk. Okay, but we don't know whether they will devalue or not. That's the first things lah. Because if you do everything that thinking that it will devalue, suddenly they didn't devalue, then your thesis is all gone, right? So pay attention to that lah, and admit that we don't know whether they will devalue. But if they are going to devalue, right, what will you do? I would say that, remember, stay away from all the USD funds, bond funds. Because if you invest in bond, right, you are getting a low returns, like you are getting, let's say, 4 or 5% yield, but just the currency devaluations can wipe out already. So that one you need to be careful. So don't invest in that. You can stay away from US stocks entirely. Just focus on your local market if you are fine with your local markets, because doing that you totally get out from USD exposure, right? That is one way to not expose yourself to USD. That's maybe one way. If you invest in US stocks, I think I'm mixed feeling on that. The reason is because when you invest in US stocks, right, let's say just take S&P 500, right, of course, there are businesses that is really US centric one. For example, they have production, they have services in US, and then most of their revenue is in US. And if that is the case, right, if USD devalue, right, you will suffer for this kind of businesses. Because now your USD revenue suddenly just worth a lot lesser. Okay, so that's one part. Let's say if you invest in companies that is quite global one, say for example, let's say Apple, they are quite global one. They sell to Europe, they sell to Asia, they sell to China. Okay, if you talk about Google, Meta, their advertisements really sell to the globe one. They sell globally. Okay, for this kind of businesses where they are global in nature, if USD devalue, right, actually they are relatively okay. The reason is because now their overseas revenue, right, become a lot more valuable in USD terms. So they actually benefit from that. But any benefit that they get, right, in USD terms, right, when it translate back to, let's say, if you are based in Singapore, right, translate back to SGD, you might still suffer. So when it comes to currency, quite complicated web that you need to navigate. Not so easy, huh? That's why if you think that it is bad, to me, the best way is just to don't expose to that entire place lah. So that one you can do that, right? But if you just limit your investment just to a small place like Singapore, right, and just giving up on entire big US market, to me, not a good idea. So yeah, again, come back to monetary things, right? I don't think USD is going to devalue a lot against Singapore, right? Because if you understand all the monetary things, right, actually most countries, right, they don't have the explicit peg to USD, but still when USD devalue too much, all the other countries, they also devalue together one. So there's some form of like the pegging, but they don't call it explicit peg, but still they tend to move together one. So I don't think USD is going to devalue a lot against Sing for a long period of time. I don't expect that just because of how MAS managing the currency. Okay, I think that's my comment on this. Nobody can predict all these currency movement. It's too hard. The macro knowledge that you need to navigate is just crazy. Or only those like George Soros or Sally Druckenmiller can navigate this. The rest, you and me, we can't. Just accept that. All right, next one. I see that most Singaporeans invest in condo as it always goes up and up. What's your thoughts on property versus stock market? Wow, this topic, if we want to debate this topic, I think even 30 minutes is not enough. On one hand, I see that yes, it has been doing well for many people who bought into condos. They bought already. I can see that. I don't want to be the one that sounds like the sour grapes. Okay, I don't do that. I stay at HDB. This HDB I bought less than 400,000 in about 2018. So how many years already? 7 years already. Yes, appreciated in value, but I see it as a place to stay, not as an investment. Okay, it is not my nest egg. My nest egg is really my stock portfolio, right? So that's my philosophy when it comes to investing. Okay, I see it like separate things. One is investment. One is really need-based kind of place to stay. As long as I don't need to, suffer the situation where the landlord say, move out, I want to take back my property, then I need to find a place to stay, right? Don't need to suffer that. To me is good enough already. I want stability, and to me, I don't need to big from my property. So that's my philosophy when it comes to managing the property versus stock market, right? But I know that many people, they play the upgrade games, they buy HDB, then sell, they buy EC, sell EC, buy condo, then keep on upgrading, and then they have, if you look at their balance sheet, they have quite a good equity value, right? So they are on papers millionaires, right? You ask me whether that works or not. I think it works for these peoples, right? So there's nothing wrong with that now. It's just that you need to understand the game, then you see which one fit to your own philosophy more, and then you just execute it. No? So, I mean, the stock market part, you can, ask more questions. You can ask me, you can ask, let's say, like Contractor, you can ask Chicken. We all, we invest in stocks, so we can give you the perspectives with regards to stock market investment. But if you want to ask about property, you can just, go and do some shopping, meet property agents, ask what's the game that they are playing, get some insights from how they invest. So I think it's quite interesting also on that front. Yeah, then you see which one fit you more, right? Some people, they just naturally wanted to invest more on property. I don't see anything wrong with that. The only thing that I want to, cautions is that, let's say if you buy property, let's say you buy a condo, right? And your expectation is that, I look at condo prices increased by X% over the past 5 years, and I think that it will go up at this kind of pace for the next 20 years. If you have that kind of expectations, then you need to be careful already, because you don't know one. I give you one example, right? You can just look at property in other geography. Just name one, right? In Malaysia, KL, right? The property prices, the condo prices also went up like crazy in certain period, and after that it just keep on going down. And why it went down is also because of oversupply. Okay, I mean, Singapore, of course, people say that Singapore is just island, the land size is limited, it won't suffer the situation that KL is suffering. But I mean, let's say if there's too much political will to push towards more land supply to have more condo, right? Can that actually make the condo or property prices stagnant for a long period of time? Is it possible? I see that as, it is possible. I'm not saying that is my base expectation. To me, it's like it is possible that the property prices can stagnate or can even go down a little bit for extended period of time. To me, that is possible. If you ask me, is it possible for stock market? To me, it's also possible. But I would rather bet on businesses growing their revenue than betting on property prices continue to go up. So that's my thoughts on this. But again, I tell you, right, this topic, right, we can have the real estate guru, and then we have stock market guru, and then come and debate, right? This one won't finish one. You need at least reserve 1 or 2 hours to have this kind of debate. Okay, I'll stop here for these questions. Next one. How long should I outperform the S&P 500 before shifting my monthly ETF DCA into personal stock picks? I've been outperforming for 1 year plus. Wow, I don't know. Let's say if you think that you can outperform S&P 500 for long term, for decades ahead, why should you go to S&P 500? You should continue to do your stock pick, right? Yeah, so I think, okay, first thing is that 1 year, right, is just too short. Even 5 years is too short. The really skill, like the outperformance that can really point towards that you really have skill against the market, right? It's really, you need to have at least 10 years, right? So less than 10 years, to me, the luck is like too much of it is due to luck. I'm not saying that you don't have the skill. I'm just saying that the 1 year is just too short to make any review. It's just too short. Okay, but of course, if you think of like, I think the ETF DCA versus the individual investing, right? To me, it's not about like whether you outperform for 1 year or 2 years. To me, it's two separate things. The ETF DCA is just like the approach to get exposure to stock market without spending too much time doing all this kind of researching. So that one is the reason to do ETF diversified investment, right? Not so much about the outperformance. So two different things. Okay, next one. Many people are saying massive USA bonds are expiring in June. Is it really that serious? I know which video that you are talking about. There's this Mandarin channel that says that, wow, you need to pay attention to this date, end of June. US have to refinance the debt. Watch this day, market is going to crash. I tell you, that channel, right, is really a lot of bullshit into that channel one. And I can comment this is because I actually tabulated, for example, like you look at how much USA bonds expiring by June, right? Of course, it is quite a big amount. But I just look at 1 year back, right, which is the data as of March 2024, right? And looking at how much debt maturing by June, right, is actually about the same as this year. So whatever that YouTuber talk about, like the bonds maturing, such a big things, the world is falling apart, all these things, right? Like sensationalize all these things, right? And it's as if like things are blowing up, right? Why it didn't blow up last year, right? Last year also similar amount of bond maturing in from April to June. So that channel, I would tell you, if you are watching this, right, I tell you it's a lot of bullshit, man. But it's quite engaging type of content, and I look at the sub counts, it's already quite big. But it's too much conspiracy theory into that now. I don't think it is helpful, you know. Next one, may I know your thoughts on Grab? I can't find what makes it special among the competitors. I also don't know. I haven't really studied Grab. Can I give it a pass on this? I'm new to S&P. Is Endowus Amundi Prime USA Fund a good place to start? Thanks. Yes, I think for those who are using Endowus platforms, right? I think the Amundi Prime USA is a good place to start. You can't call it S&P because they didn't pay S&P licensing fee, so they can only call it USA Prime USA Fund. Okay, so but essentially their correlations to S&P 500 is like what 99%. I've looked at it before, so it is a good start. You can think of this as S&P 500 equivalent, no problem. But on the Endowus, right? I thought that Endowus is the only place to invest, let's say like your SRS money. But apparently, I heard that Poems also can invest SRS and also CPF funds. So I haven't done a lot of research on that. But at least for your situation, I don't know whether you are investing cash or SRS or CPF, right? I don't know. But let's say if you are investing those money, you might want to check whether Poems is like cheaper. Okay, you go and find out. And then second thing on Poems, is there any other better funds? And are they cheaper or not? I also don't know. You can do more further research on that now. So, but at least, let's say for my SRS money, right? Because I already set up already, I'm using Endowus, I'm investing in Prime USA Fund. That one, for me, that part is continue. I haven't switched to any other platforms. I'm still using. By the way, anyone using Endowus, if you're interested, I just put my referral link at the description now. Thank you so much on this. Why choose REITs over China banks or insurance when they have higher yields and sufficient safety margins for maintaining dividends? You ask me these questions as if I need to defend this statement, but I didn't make this statement. Why choose REITs over China banks or insurance? Actually, first things, China banks, I haven't been covering China banks. You might want to listen to Chi Geng. I think he talked about China banks before now. So you can post these questions to him. Insurance, I also don't know. Maybe I think you are referring to Ping An Insurance. I haven't really paid attention to that area, so I don't know. Then now, why choose REITs? When you talk about REITs, I suppose you are talking about Singapore REITs. Singapore REITs, I mentioned before, I have some Singapore REITs. People ask me what's my expectation of Singapore REITs. I say my expectation is that they are able to continue to pay whatever dividends that they are paying now. Let's say when I buy it, let's say their yield is 5 to 6%, I do think that they are able to pay me 5 to 6% dividend yield over the next 3 to 5 years. That's my expectation. The price can come down, I don't know, because sometimes the price can fluctuate just because, let's say, like the long-term yield is moving, right? So they will be affected in terms of their valuations. But when it comes to the cash flow, right, in terms of how much they are able to pay, right, I think as long as they are able to pay 5 to 6% dividend yield, I buy now, I can get that. I don't think they are going to the moon. So I can comment on Singapore REITs because I have covered before. I can debate on that. But the the China banks and insurance, please ask anyone that mentioned those two investments, ask that person to defend his statement or her statement. I actually don't know about this. Next one. Are you concerned about NVIDIA long-term earnings due to Huawei AI chips and the US banning export, given that 20% of revenues from Singapore export to China and 17% China? First thing, short answer is no, I'm not concerned. I think just excluding the China, right, the rest of the market, the size of the market is big enough. So I'm not that concerned on that. The second part about Huawei AI chips. Huawei AI chips simply is not as good as NVIDIA. It's just far behind. So in terms of competitions, nothing to worry about. Of course, if I'm NVIDIA, I hope that export to China remain like they can still ship something to China. So the larger the market, the more they can serve, the more they can earn, right? That is definitely true. But I mean, the situation is this. US is tightening all these things. They don't want China to grow too fast, especially when it comes to AI area, right? So all these restrictions, whether it's EUV, whether it's NVIDIA chips, I think all these restrictions will come, okay? So, I mean, this is not something that I can control, right? If this kind of restrictions, more and more these restrictions comes, right? What happens is that the China versus outside of China, these two markets will start to, become two distinct markets. So it's actually bad for NVIDIA. It's true. What happens is that, let's say Huawei, even with some inferior chips, right, actually they are able to sell. Whereas, let's say if they have to compete with NVIDIA, it's a lot harder. So this news, right, is actually bad for NVIDIA, good for Chinese local chip designers and chip manufacturers. But I mean, sometimes all these things is not done to benefit NVIDIA. It is really done because of the security reasons. And sometimes once this thing is come out, right, you just need to accept. If you need to accept that the size of your market is small, then you just need to accept, right? Say for example, Meta, Google, I don't think they have large market share in China, right? So they just can't serve that market. Is that means that they are not investable? No. It just limit the size of their market, right? So that's how I see it. Next one. Do you think it makes sense to invest 20% or so into China market right now? It seems that US is declining. First things, actually, when it comes to whether US is declining or not, these are kind of like market timing costs, right? Which I will tell you, hard to say one. We don't know one. It could be bottom from here, just go up only. We also don't know. So the market timing part is really too much unknown. Okay, that one aside. Now, talking about the 20% into China, whether US is declining or US up or China is declining or China up, the market timing aside, right? Just think of it like you don't know which one is declining, which one is going up, right? You still need to think about like what kind of allocations that you want to have. By allocations, I mean allocation into different asset class, like how much to go into real estate, how much to go into bonds or fixed income, how much go into stocks. And then when it comes to stocks, right, you need to think about how much you want to put into China, in US, in Europe. You need to have a view. Once you have that view, right, and if you're happy with that 20% into China, right, then whether you think that China is going up or down, maybe just DCA a bit into China, just have long-term exposure, just hold long-term, believing that even China is governed by CCP, which is communist, still capitalists can make money. At least you need to have that kind of beliefs, right? Then it's fine to have 20% into China. I myself, I have about 20% of my allocations in China. I have Tencent, I have Meituan, and I have some Chinese ETF, right? So to me, I still betting on China. It's just that when it comes to allocations, I don't have a sizable allocations. So that's that questions. What's a good platform to track the stock return if you are using multiple brokers? Wow, this one. I don't have recommendations there. I need to check. The one that's Contractor is using, I think looks quite neat, but I haven't been using that, so I actually don't know. What else? I actually don't know. Let's say if I really just have this problem, right? I will just make sure that I have everything inside Excel spreadsheet and then I will track it manually. So that's how I will do it. It's just too difficult to have, because let's say if you have platforms and then you want to use platforms, So you still need to manually key in, or some platforms allow you to upload like CSV upload now. So that's workable, but still you need to put that in. And then in terms of what kind of metrics that you can extract from that platforms is also platform specific. So I prefer to have things on my hands that I can massage and I can do my thing. So I don't have this problem in the past because I'm always very focused. When I share my allocations, I share my investment, I am referring to IBKR, which is bulk of my money. The rest, right, like I say, I have some Singapore REITs. Don't ask me about that one. It's just too small, okay? Too small. That one is really in separate brokers. And I don't share my returns. I don't even look at the returns from that portfolio. To me, it's just a small portfolio for me just to collect some dividends. That's it. I don't look at the returns one. But when I look at the returns, I look at my IBKR, and I rely on IBKR when it comes to, let's say, like tracking my investment returns and so on. It keeps my all these trackers simpler. Okay, thank you so much for all of you joining me live here. I think it's quite interesting. Again, we have like 44 people here still live. At the peak, it's about 60 people. Still surprised, right? We start at 10:30. It's really close to 2 hours, and still people treat this like a radio show already. Thank you so much for joining, and enjoy the rest of your weekend. All right, see you. Bye bye.